Well, good afternoon and welcome everyone to Johnson Lambert webinar on decoding the regulatory mindset on internal control and COVID-19 impact. I'm Magali Welch, partner with Johnson Lambert, and I will introduce your speakers in a moment. But before I do so, I'd like to go through a few administrative items with you. You can download a copy of today's presentation from the resources window. If you do experience any technical difficulty during the webinar, please click on the help icon. And to engage with our great presenters, please submit your question in the Q&A window. We will do our best to answer as many questions during or at the end of the session. We are offering CPE CRE credit for participating in today's webinar. To receive your 1.5 CPE or CRE credit for today's session, you will need to be present for the full 75 minutes and answer at a minimum 5 of the polling questions. So without further ado, please join me in welcoming our speakers. First, I want to welcome Joanne Smith and Rick Nelson. Both work in our regulatory practice and specialize in highly efficient risk-focused examination. Good afternoon, Joanne and Rick.
Thanks. It's nice to be here today.
Yes, good afternoon. Welcome, everyone.
So next, I want to introduce Josh Keene, Audit Partner. Nice to have you with us, Josh.
Happy to be here.
And last but not least, join me in welcoming Kim Mobley, partner in our IT consulting practice. Glad you are here with us to provide some IT insight, Kim.
Thank you, Mag. I look forward to the session today.
So before we dive in, I want to take a few moments to express our thanks to the medical professional and all essential workers who have been working so hard to serve our communities during these uncertain times. And we hope also that you, your family, and co-worker are staying safe. So today our session includes 3 separate sections. We will begin by providing you background and valuable information to help you decode the regulatory approach for determining and testing internal control so you are ready for your next regulatory financial examination. The team will also discuss the impact on COVID-19 on the examination. During part 2, we will share our thoughts on areas where organizations may need new or enhanced control over financial reporting. We will also touch on fraud, as with these uncertain times, it's possible that fraud may be on the rise in light of the pandemic and the effect on the economy. And for our last section, we will discuss why it's critical for an organization to understand the IT system and control changes to support the remote work environment and other changes within the organization. So with that, we are ready for our first polling question, and it is for my organization next statutory financial examination. I have the most question concerned about which internal control will be tested and if our documentation is adequate, which statutes, laws, regulation will be tested for compliance, which financial statement balances will be tested for accuracy and completeness, or it's not applicable because you are a great regulator or Johnson Lambert employee. So I know there's a lot of choices here. Make sure when you have selected your choice that you push on the submit button. And I want to remind you that do not answer your answer in the Q&A section, as they will not count towards your CPE CRE credit. And I will leave you just a couple more seconds and I will show the results. Okay, so most of you seem to be wanting to know more, have question or concern about what will be tested and if your documentation is adequate. So I'm sure our Rick and Joanne are going to be able to answer some of this for you. So with that, we're ready to dive into our first part of our presentation, and it's how to prepare for the next statutory financial examination. So during this section, we will discuss what you should expect during the regulatory examination of your internal control testing, and what happened after control is tested, after that team is done. We'll also touch on the different approach taken for small insurance company, captive, and risk retention group, which is great that there's, some kind of different approach. And finally, our regulatory team will also share the impact on COVID-19 on the examination and the result, because there are some examinations that are going on right now. So Rick, insurance companies have annual audits signed by their CPA. And during the planning phase of that annual audit, the CPA firm evaluates the design of the key internal control for balances that are risk and material misstatement. This is only really to perform to assist the auditors in designing their audit procedures. They may test the internal control, but more often they don't. The requirements for financial examinations seem to go much deeper. It seems that you evaluate the design, but also you test the operational effectiveness of the internal control. So can you please walk us through the requirement and what documentation the financial examiner is looking for?
Yes, thanks, Meg. During the financial exam process, examiners do a more in-depth review of companies' internal control structure, and actually we do perform detailed testing of controls. The objective of this process is to obtain a level of comfort that the internal controls are operating effectively, which could ultimately allow the examiners to reduce the scope and extent of detailed testing. And we will discuss this process later in the presentation. The statutory financial examination focus shifted from a traditional balance sheet review to the risk-focused approach many years ago. Previously, regulators focused on a company's balance sheet at a point in time and reviewed or examined material balances similar to a traditional audit approach. States recognized that this method sometimes provided outdated information, as many exams were completed 12 to 18 months after the reporting date, or potentially duplicated information already covered by the external auditor review. With the shift to a risk-focused approach, regulators are now looking at a company's risk profile, key risk areas, and policies and procedures to develop an understanding of how a company addresses internal and external risks. The goal of this review is to identify areas of higher risk and then focus examination efforts on those areas for greater examination efficiency and effectiveness in the Phase 5 detailed testing, which we'll talk about in just a moment as well. Additionally, regulators recognize that some companies have other internal and external parties who are also reviewing and testing controls and processes, such as internal auditors, SOX and MAR compliance reviews, external auditors, and other parties. The NEIC handbook has incorporated guidance for examiners to allow for review and incorporation of this testing into the examination process to maximize efficiencies and to reduce potentially duplicative efforts of examiners. The Phase 3 testing review is the company's opportunity to provide regulators with an overview of how they manage the risks specific to their businesses and operations and what procedures and controls they have in place to mitigate those risks. Risk mitigation strategies include both automated, system-driven controls as well as manual procedures. And again, we'll be discussing these in more detail later in the presentation. With the shift to the NEIC Financial Condition Handbook and to the risk-focused approach, the financial exam process moved to a 7-phase approach. During Phase 1 and 2, examiners begin with their understanding of the company, including an assessment of corporate governance, an assessment of external and internal audit, if applicable, and identification of key risk areas and risk statement identification. This is referred to as the planning phase of the examination, and during this time, the examination plan is developed. Input is provided to the exam team from the department's financial analysis section, which typically highlights the results of annual reviews conducted during the examination period and identifies any issues or concerns to be addressed by examiners. The Phase 3 process of risk assessment and control testing is where examiners will review the company's internal control environment to identify key controls and risk mitigation strategies utilized by the company and perform testing of those controls based upon examiner judgment. We will focus on this phase during this presentation. In Phase 4, the residual risk assessment, based upon the results of the Phase 3 testing and assessment, examiners will determine the residual risk assessment for each of the key risk areas and rank each area, high, moderate, or low. This assessment will determine the extent of any substantive testing needed in Phase 5, and any risk resulting in a residual assessment of moderate or high is required to be further reviewed in Phase 5. In the Phase 5 area, we're reviewing and performing substantive testing. This phase of the examination is where examiners will conduct any substantive or detailed testing needed on those high-risk areas. Phase 6 and 7 is the reporting phase, where the examination report, management letter, and other internal examination deliverables are developed. Examiners will report the results of the examination back to the department's financial analyst through an SRM or summary risk memo, which highlights the results of the examination and makes recommendations for follow-ups as needed by the analyst after the exam has concluded. This coordination between the financial examiners and the financial analysts at the beginning and end of the exam process is an important element of the success of the regulatory review process. Next, we'll be talking a little bit about the risk assessment, mitigation strategies, and controls in a little more detail. So again, this session will focus on the Phase 3 assessment. Using the guidance in the NEIC handbook, examiners will review each of the key risk areas identified during Phase 2 with the focus on determining and assessing how the company internally addresses these risks. Examiners will evaluate the design and operating effectiveness of internal controls through review and testing. Typically, a sample of controls will be selected for review. Sample sizes will vary depending on the frequency of the control, and examiners will utilize professional judgment in the assessment of the effectiveness of the control and in the development of the final assessment process. And Joanne will review this process with us in a little more detail later in the presentation. During review of a company's risk mitigation strategies and controls, examiners will evaluate the company's management oversight. Management oversight would extend from the line-level managers to senior management and finally all the way to the board of directors. Evidence of review would be expected to be documented and maintained in the key areas of review, approvals, reconciliations, etc. It is important that a company is maintaining evidence of the completion of a control in addition to the control procedure itself to allow for a third-party reviewer, examiner, or auditor to verify that the control is operating effectively. If evidence of the control is not available for review, the effectiveness of the control may not be recognized in the assessment. And as an examiner, this is one of the areas that we tend to struggle a little bit with the companies as we're reviewing those internal controls, is making sure that the documentation is maintained to demonstrate that the control is operating effectively during the exam period. A review of policies and procedures is a typical starting point in the identification of key controls for review. Again, it is important that the company have formal documented policies and procedures to allow for ease of examiner reviews. Other controls reviewed related to risk management or how a company is evaluating their internal risks. Typically, some level of risk may be appropriate for a company to retain, and discussions are typically held with examiners to discuss the rationale and strategy for these risk levels. Examiners will focus on what procedures a company has in place to internally monitor controls to ensure that they are executing properly. As we noted previously, examiners will often request access to many different sources of control listings, summaries, and testing for review and incorporation into the examination process. Sources of this information may include testing conducted as part of a company's SOX or MAR control review processes, if applicable, work that's conducted by internal auditors, process narratives, flow charts, or documentation prepared by the company, or external audit control testing or narratives. Again, the objective of this review is to maximize exam efficiencies and to reduce potentially duplication of effort. If these processes and procedures are being reviewed or have already been reviewed, examiners can utilize this information as part of their review as well. Now Joanne will discuss some additional considerations of our Phase 3 testing approach. Joanne?
Thanks, Rick. So now that we've discussed the sources for control statement identification, I wanted to share a little behind-the-scenes insight into what regulatory examiners are thinking when conducting the Phase 3B control testing portion of the risk-focused financial examination. Hopefully this information will shed some light on the why behind the requests by examiners during this portion of the exam. But first, let's discuss why regulatory examiners test controls in the first place. As Rick mentioned previously, regulators focus on diving deeper into the key drivers that could lead to insurance company insolvency. And one of those key drivers are ensuring appropriate oversight by qualified and experienced management on a routine basis, and the establishment of effective and robust internal control processes. Therefore, examiners must verify the appropriateness of the design of controls and the operating effectiveness of the controls. The good news is that examiners do not have to perform all control testing from scratch. They may place reliance on the work performed by internal audit, SOX and MAR teams, or even the external auditor. Now, there's one important caveat to keep in mind. When examiners place reliance on control testing performed by others, they must confirm the independence and experience of the individuals performing the work. They should review the control testing support and understand the scope, population, attributes tested, and conclusion. And they should follow up on any control issues noted. And finally, examiners must ensure that the testing meets the NAIC Financial Condition Examiner's Handbook guidelines. So there are multiple reasons and influences on the types of follow-up questions and requests that examiners may send after taking an initial look at the internal audit work papers. As an examiner that represents the State Department of Insurance, I'm frequently asked questions by insurance company executives such as, why are you guys testing this area? Or why can't the examiners rely on the work that our internal audit department did last year? And my response is always that there are multiple reasons for regulatory examiners to perform their own independent testing. And I wanted to share some of those reasons with you all here on the webinar today. First, perhaps that particular control point was just not tested by internal audit. For example, liquidity monitoring is a control area that is rarely tested by the internal auditors since it does not get reported on the financial statements and is not directly tied to a SOX or MAR requirement. However, examiners consider this a critical risk category and evaluate the insurer's liquidity and short-term cash flows. Another common reason is that the sample size was not sufficient to meet the NAIC guidelines, which I will elaborate on later in the presentation. The extent of independent testing can also be influenced by the exam team's initial assessment of the internal audit department. To give a little context to this, at the very beginning of the exam during Phase 1, examiners assess the independence, expertise, and audit plan of the internal audit department. And in some instances, examiners may determine that internal audit is not effective or not independent. And this will result in the exam team deciding that they will either reperform the work of internal audit or select independent samples. Finally, per the NAIC handbook, examiners must also have the discretion to utilize professional judgment when determining the scope of the control testing. And while not directly a function of independent testing, there are also instances where examiners might request meetings or walkthroughs of a control process directly with the control owners in order to gain a deeper first-hand understanding of all the controls and a sequence utilizing real examples. This might especially be true for compliance areas that involve policyholder-facing activities like claims handling or underwriting. Now, as I just mentioned, when the internal audit does not test sufficient sample sizes, that's a common reason for independent control testing by examiners. On the slide is a table, which is an excerpt of the sample size guidance from the NAIC Financial Condition Examiner's Handbook in Exhibit O, Part 1. It breaks down the required sample size by control frequency, such as annual, quarterly, or monthly. An important guidance point given to examiners is that sample sizes should be towards the high end of the range if the planned level of risk mitigation is strong. And conversely, if the sample size is at the low end of the range, risk mitigation assessment is moderate. So what does this mean? Examiners will require a sample of 5 for control of a monthly control frequency in order to determine that the control is operating effectively and has strong risk mitigation. Often we see that internal audit has tested a sample of 3. Therefore, examiners usually have to test additional 2 samples to reach a grand total of 5. Now, there is some professional judgment allowed to examiners for this sample selection, especially for ad hoc controls that may occur at irregular intervals or are transactional in nature. For example, if all reinsurance contracts are reviewed by the CFO for risk transfer in compliance with state statutes, but approval sign-offs only happen when a new contract is entered into, this would be considered ad hoc control. And if there are about 4 new reinsurance contracts a year, that would be an ad hoc control with approximately quarterly control frequency. Another type of control to think about are the IT automated controls and the role they play in the organization. Depending on the landscape of the entire control environment and the significance of that particular point in the process, examiners may evaluate the design and operating effectiveness for the automated control in key systems. So how do we do that? For automated controls, examiners select a sample of 1 to confirm that the process is operating as expected in a given scenario. For example, the claim system may automatically sort out and send claims over a certain dollar amount to a separate high-dollar claim processing queue. Examiners would select a sample of 1 large claim to make sure it was properly categorized as high dollar. Okay, the super sleuths out there might have picked up on my earlier mention of risk mitigation assessment as strong or moderate, depending on the sample size. And that overall assessment is the final piece in the puzzle after examiners test controls. Some common factors that examiners weigh when determining the overall risk mitigation assessment conclusion are as follows. If the control is verbal only, or if there is no written evidence like a sign-off, or maybe the control was not consistently performed for every period selected for the sample, then examiners will assess this control as providing weak risk mitigation. On the other hand, if there is written evidence like a sign-off to support the effective operating performance of a sample of 3 for a monthly control frequency, then examiners will assess this control as providing moderate risk mitigation. Finally, if there's evidence to support a sample of 5 for a monthly control frequency, then examiners will assess risk mitigation as strong. Overall, the basic theme here is that written evidence of controls of a corresponding sample size is required in order for the examiner to determine the overall conclusion. Okay, now at this point you might be thinking, why does it matter if examiners pick moderate or strong risk mitigation assessment? Well, this selection factors into the formula utilized for calculating residual risk in phase 4 of the risk-focused exam. And ultimately, the overall risk mitigation assessment plays a major role in determining the extent of detailed or substantive testing that the regulatory examiners will conduct in phase 5. And the extent of phase 5 testing could influence the examination budget or the length of time that it takes to complete the exam. In addition, if there are significant concerns with the control design or control documentation, examiners may issue findings or exceptions to provide recommendations for improvement for pervasive control weaknesses or about the general lack of evidence to support the overall operating effectiveness of controls for a certain key functional area. For example, examiners might point out specific areas like liquidity monitoring where controls should be formalized or record retention improved. And in the end, examiners may include these internal control recommendations in the final public report on examination or the management letter that is delivered to the board, depending on the level of severity or other factors. If the internal control concerns are less severe, examiners may instead provide informal feedback on the appropriateness of the design of the controls and suggest improvements as a best practice or verbal comment only. Therefore, it is important to ensure an adequate level of implemented controls that can be verified through control testing to meet regulator expectations. And taking the time to formalize and document controls does not only serve to get prepared for the next regulatory examination. At the core, a well-designed and effective system of internal controls provides assurance to company management and to the board of directors that their staff are performing certain basic processes on an ongoing basis to ensure complete and accurate financial reporting and ongoing compliance with key regulations. Ultimately, strong internal controls provide long-term benefits to the entire organization and to all of its stakeholders. And now I believe we have a polling question. Mag?
Great. Well, thank you, Joanne, for all that great information. So our next polling question is, my organization's internal control and control documentation are well established with robust internal audit, MAR, and our SOX. Good, but could be improved with limited internal audit function, limited, or not applicable. And again, if you are a regulator and you are entering D, you will still get your CPE CRE credits. And I will leave a couple more seconds for this poll for you guys to answer. Okay, closing the poll. Okay, well, it's number A and B is pretty close, but it seems like most of you answered B. So, Rick, were you surprised of this? Were you expecting that I would say the majority were, good, but could be improved?
Yes, excuse me, thank you. I think that is probably, in my mind, what I would expect to see as well, depending on the companies that are participating. A lot of times we are looking at the internal control structure and can suggest areas of enhancement or improvement to the process as well. So it's probably very rare that there's a fully functioning internal control environment with robust controls and in place as well. So I guess I would expect more of a B to A kind of expectation for the responses here. We also, it looks like, had a polling question a question that came in on the team chat, on the chat function, looking for what are the weakest controls that you are finding. And I think from my perspective, again, I think that kind of ties back with our discussions earlier as far as the controls in place at a company. Not necessarily that the controls are not in place and aren't operating, but the documentation of the controls may be missing or lacking as well. I know in a few of our recent exam projects, we've had comments that we've made related to that documentation or evidence of the control. And, that could be a review of a listing or a detailed report, and then a senior manager or someone above reviews and signs off on that. Did they retain some evidence that sign-off or review has been conducted, and then, keep that for retention purposes? The same thing for some controls are in place that are executed through an email function. For example, an investment report might be circulated to key members of senior management for review, and they acknowledge that through an email function. But then when we go to test the control and review the evidence of the control, many companies' emails are deleted after a certain period of time. So that's something that would have to be intentionally retained and saved in a location for retention purposes. Because as the examiners are coming in and looking for the evidence of that control, it might not be retain, which could be a surprise to the individuals that are conducting performing the control as well. So just keeping in mind the retention and the documentation of any controls is an important part of the process.
Right. Well, thanks, Rick.
Excuse me. Sure.
So you and Joanne gave us some great insight into phase 3 of the financial statement examination, but what about smaller organizations? Do you have different requirement or a specific different approach? Talk to us about this.
Yes, thank you. That's a great point because, obviously it is important that examiners are giving consideration to the size of a company. The size, complexity, and sophistication of a company's operations may be indicative of the level of internal control processes and procedures that they do have in place. You would expect a larger organization with a well-established internal audit, perhaps a SOX and MAR function due to requirements, an enterprise risk management function, et cetera, may have much more documentation and support available for review than a smaller company, potentially a captive or risk retention group may have. This does not mean that a smaller company cannot have effective controls in place. Rather, the focus of the exam activity may be a little different during the phase 3 review, and examiners will still need to conduct a review of the company's internal control structure to make that determination. Factors that may limit examiners' internal control reliance on documentation may include, the fact that a company may not have an internal audit function, or if they do have an internal audit function, especially if they're part of a holding company, the size of the legal entity being reviewed might not meet the materiality scale of the internal audit scope, so they might not be included in the testing. A company may not be of a size to be subject to SOX or MAR requirements because of premium volume or other thresholds as well. A company may also utilize a captive manager or administrator to provide all administrative and financial reporting services, which creates different challenges. And there may be limited or no documentation of internal controls, as we mentioned before. Again, none of these exclude the responsibility of having some type of internal control structure, and examiners will want to have a discussion with the company to go through these items and to understand the current operating environment. The handbook does provide guidance for examiners when reviewing controls at a small company or captive environment. The inability to rely on internal controls does not necessarily mean the conclusion for the examination to be negative. There is some expectation for any size company, at any size company, that there are some internal control activities. However, the inability to rely on internal controls may shift the focus of the examination to a more substantive or detailed testing approach in phase 3 based upon examiner's judgment and the result of the internal control review. A small company should be candid with examiners when requests for internal control documentation are made. If a no reliance strategy on internal controls is appropriate, the sooner this can be determined, the better, so that the examination can proceed effectively. The company may want to create process narratives or flowcharts for key functional areas if they do not exist for documentation purposes. Even in a small company environment, some level of control should be in place. Related to typical areas include segregation of duties, review of key reports and financial statements, levels of authority, limiting access to certain programs or functions. These are all examples of controls that typically would be in place in any size operation to some extent or in some capacity. Controls extend to the highest level of an organization as well, and oftentimes these aren't really considered to be controls, but they would be considered in the examination review. And some of these include, the board of directors' involvement and review of financial statements, review and approve of material agreements and contracts, discussion and approval of key initiatives, and approval of investment transactions. Again, some companies haven't necessarily envisioned these to be controls, but in the eyes of examiners, these are key functions that we would anticipate reviewing, and we would look to the board to have those controls in place. Examiners are required to perform some level of internal control review. In the case where limited or no controls exist, examiners will document this in the examination files and may also perform additional testing in the phase 5 area. In cases where controls were found to be limited or non-existent, examiners may include comments in the management letter or other communications for future consideration by the board or senior management. And again, in a couple of recent exams that we participated in as well, we actually had developed a couple of comments that were included in the management letter that was shared with the company and the board, just to highlight some of the deficiencies that we did find in the internal control area. And a lot of those specifically were related, as I highlighted earlier, on lack of documentation. So because we couldn't verify that the controls were operating effectively or operating at all because of the lack of documentation, the conclusion tended to be more of a higher risk at the end of the day. Now I think Joanne will discuss some tips and considerations for preparing for your next statutory financial exam. Back to you, Joanne.
Thanks, Rick, for sharing those insights for small insurance companies. So now that we've discussed why examiners test controls, I want to spend some time discussing what your organization can do now to prepare for the next upcoming financial examination. These ideas are applicable to any insurer, large or small, with simple or complex internal control structures, or robust or limited internal audit departments. Just scale these ideas to match your company. So a good place to start when preparing for an upcoming exam that is called by your domestic insurance regulator is to first update the cumulative list of control points, or the control universe, to accurately reflect all key controls and functional act areas like investing, underwriting, reinsurance, reserving, and claims. It is also helpful to brainstorm to identify key control processes that may already be occurring in practice, but maybe are not yet formalized as a control point. One best practice that I always find useful in helping to communicate clearly about which control is being discussed at any given moment is to assign each control a unique reference code or identifier, which can be utilized to quickly cross-reference that exact same control point whenever it is referenced in flowcharts and narratives. For example, labeling the approval investment transactions as reference code INV-100. Then it's easy to retain to evidence of the effective performance of that control organized by reference code in a centralized location. Another tip is to make sure the various control documentation is current by updating the process narratives and flowcharts to best describe the control universe before the regulatory examiners arrive. Examiners will request these documents to assist with the control identification process, as we discussed earlier. Keep in mind that effective controls are a team effort. Encourage all staff throughout the organization to diligently and timely document reviews, approvals, reconciliations, and sign-offs for key control points. And when regulatory examiners request evidence of controls, it is a request for whatever existing documentation may be available from that prior time period, and not for a new document to be created just when it was requested. If a control was not formalized or documented for the period requested by examiners, no problem. Just indicate that the date when the control started being documented. Oftentimes, examiners will accept subsequent evidence of controls as support that the insurance company has a strong control process on a prospective basis. And don't forget to get the internal audit department involved in reviewing the listings of controls, narratives, flowcharts, and of course, testing all controls. Because sample size is such a common reason for additional control testing by examiners, consider asking internal audit to increase the sample sizes in their audit plan for the calendar year of the anticipated exam. For example, if your company is scheduled to have an exam called as of 12/31/2020, start increasing sample sizes now. Another option is to consider asking your external auditor to increase the scope of their assessments and documentation of both financial and IT internal controls for the audit year that is anticipated to coincide with the next statutory financial exam. Although less common, examiners can also leverage the internal control testing or documentation prepared by the external auditor. Finally, don't forget to identify and test cybersecurity and IT general controls, such as user access, vendor management, disaster recovery, and business continuity plans. Another key component of the risk-focused financial examination is an IT review, where these IT controls are reviewed by the IT specialist assigned by the department. In fact, the Johnson Lambert Regulatory Services team frequently partners with our Johnson Lambert IT specialists to provide both financial and IT examination services to insurance regulators. In summary, the purpose of control testing by examiners is to verify that the insurance company has implemented appropriate risk mitigation strategies and control processes in order to ensure accurate and complete financial reporting, appropriate oversight of significant prospective risk areas, as well as processes to ensure the ongoing compliance with statutes, codes, laws, and regulations. And at the end of the day, regulatory financial examiners are primarily concerned about the ongoing financial solvency of the insurer and its continued ability to meet policyholder obligations into the future. And ultimately, a well-designed and effective system of internal controls provides assurance and long-term benefits to the entire insurance company. And that concludes this segment of the webinar, and I'll turn it over to Mag to introduce the considerations to keep in mind in the world of COVID-19.
Well, great, Joanne. Thank you. So, Rick, with the pandemic, organization may have experienced a breakdown in review-type controls, or employees may be unable to perform control duties because of absences. How is this affecting the examination and the result of the examination?
Yeah, thank you. Definitely, those are considerations for current exams that are ongoing or in process right now at this point. You know, no one could have anticipated the events of the past 4 months. Companies have been forced to activate business continuity plans and transition operations from on-site to a remote or virtual environment within a relatively short period of time. And this has definitely created a number of challenges which were not considered as part of the continuity planning. Some items noted during recent discussions with companies that were highlighted in things that they found out during this transition that weren't taken into consideration were pretty interesting for reflection looking back at that. You know, some companies found, you know, inconsistencies with equipment from home office setups, outdated home computers, things like that, as employees were forced to work from home, typically using whatever equipment they had at home. You know, lack of laptops and other transportable equipment was something that was highlighted by companies as well. One company that we recently spoke with had begun an initiative to replace all desktop computers with laptops and docking stations at a considerable cost in preparation for future events or potential future events as well. Recognizing the need for the consistency in technology and the ability for employees to work remotely when needed. You know, obviously children at home needing computer access is something that many companies didn't consider as well, with access for schoolwork and the need for computers conflicting with parental work schedules also. And I know we've all experienced that. Lack of home office space and private working areas, as many individuals were working on dining room tables in some cases. And then just the challenges associated with capabilities for web conferencing and other connectivity issues for teams and offices in the virtual environment. So all of those things were affecting companies or had affected companies as they went through that process of transition. With the shutdown of the country, you know, state insurance departments also were impacted by this, having to transition to virtual operations as well. You know, being a financial examiner and for our team, we've always operated in a virtual environment. So there wasn't a lot of adjustment needed for us specifically, but, you know, especially for the financial analysts and the other department units that were operating in-house, you know, the transition of those team members to the virtual environment was a challenge for them as well in some cases. And then most states are still operating in a virtual capacity, although some are beginning to reopen limited operations as well. So all of these considerations could impact the effective execution of some internal control procedures as personnel and activities are shifting to the new environments. Companies needed to be aware of the need to continue key controls and may want to consider revising policies and procedures to reflect changes that may be appropriate. the importance of the effectiveness of key controls in the areas of review, approvals, reconciliations, verification testing, control monitoring, et cetera, should continue to be a priority. Many states have added procedures, including discussions with the companies to understand their responses to the pandemic as part of the examination process for current exams. And companies should be prepared to discuss their responses, contingency plans, and activities during this period with the departments upon request. And it's also important that alternative solutions for evidence of controls is developed as applicable. Again, the key controls should continue to be operating. It may be necessary to maintain email evidence of approvals rather than physical sign-off or other methods of documentation that the continued execution of the completion of control tasks and procedures is occurring or has been modified in some cases based upon the changing environment. So again, the importance of maintaining that threshold of internal control continues to be an important part. And I know as examiners, when we're reviewing information at a company, the expectation is still there that these procedures and the key controls will still be operating effectively, although they might be in a different format or a different, there may be some changes to the procedures and the processes. So again, the importance of updating those processes and procedures and keeping those current is equally important here. All right, I think that is back to a polling question.
Perfect. Thanks, Rick. So again, our next polling question is, my organization internal control were most impacted by COVID-19 and the sudden shift to remote work environment in the following manner. And there are a lot of different options here. First one is IT technical and logical issues, transition from paper to electronic files, shifts in the process flow or procedure steps, change to how approval and sign-offs are obtained or non-applicable. So again, how were your internal control were most impacted by COVID-19? And I will leave you a couple of extra seconds, and don't forget to push the submit button. Okay, and I'll show the result and close the poll. So it seems the most popular answer was A, IT technical and logical issues, but it's followed pretty closely with, shift in the process and as well as approval as well. So. Okay, so now let's move to our next section of the webcast, looking at the impact of COVID-19 on internal control over financial reporting from an external audit perspective. So Josh, the last several months have been challenging for everyone in dealing with the pandemic, both personally and professionally. And I have two questions for you. First, what have you seen as being some of the key accounting, tax, or compliance issues faced by the insurance companies? And then on a related note, fraud could be on the rise with employees, as I indicated earlier. This rise in fraud could be the result of increased pressure to meet organizational goals and targets, and due to this pressure, an employee may be cooking the books to make them look better. Or maybe it's an employee's spouse that was laid off, and there's an incentive that the employee to replace the lost income. You may also have fraud from your vendors, your TPAs, your claimants. They could be giving you, for example, a TPA can give you some fraudulent report, or vendor fraudulent invoice. Claimants can, pretend it is a claim. So there's a lot of possibility of fraud. So what can an organization do to mitigate this fraud risk? So could you provide some thoughts on these topics I've just discussed?
Great. Yeah, thank you. Happy to, Meg. Yeah, I think from the financial auditor perspective, the pandemic obviously took everyone by surprise. And I know we were in the middle of all of our financial statement audits and in the field and across the country when the country shut down. And so taking up everything we were doing and bringing it back and doing it remotely actually didn't hurt us too badly at all. We had been set up for a remote environment, but obviously the companies have been facing a lot of challenges and almost the perfect storm as you think about what the timing of this. Work from home arrangements required, middle of March and continuing through a lot of times still to today in some areas. And so that hit the financial reporting teams quite heavily in a lot of areas. The Q1 statutory filing is actually right in the middle of this. Most of the time we were seeing COVID-19 as it relates to the 2019 annual reports was being considered a type 2 subsequent event, which really is just looking at disclosure of events that happened after the balance sheet date for disclosure to the readers of some of the impacts. But Q1 really being in the middle of it and having to take into account the recognition of some of these changes that were going on as it relates to the financial markets, as well as the regulatory initiatives to relieve some of the burden on the economy and the individual policyholders. So I know everybody saw the financial market volatility as a component. Tax changes came through, the regulatory initiatives as far as relief to the policyholders, but also looking at data calls from either analysts and or the regulators to understand the impacts on solvency and getting in front of the curve, make sure the organizations had a plan in place. And this really kind of was one of those forced upon disaster recovery business continuity tests. So make sure you take credit for that in your documentation, that this test of the plans there went into action, and make sure you're using these as lessons learned. And I think the other one I want to take some time to talk about too is just looking at the risk environment and the new norm. What does this look like with remote work, and how do we change the environment that we live in, and especially as it comes to the oversight that occurs when a manager is looking over the shoulders of an employee and having controls in place in that live environment rather than being remote. So let's spend some time looking back at the financial markets. Q1 is obviously when the stuff hit us all in the face, and the markets took a really bad dive. The S&P 500 and the Dow dropped about 35 to 40% from their highs in February to lows on March 23rd. And then we're looking at Q1 financial statement reporting. And what does that do when organizations are looking at their stock and or bond portfolios? And the bond portfolio looking at some of these issues related to the creditworthiness of the borrowers and the ability to repay, and do we have credit events that need to be taken into account for financial reporting. So luckily we had some hindsight, as we go to close the books in Q1, the markets did rebound. And if you look at them today, we're up again. So happily, a lot of this was just short-lived downturns, but obviously real impacts to organizations as they look at their liquidity as well as their overall capital position, with the mark-to-market changes in carrying values for equity securities on a statutory basis, driving down, obviously hitting that into surplus as an unrealized loss, even if you haven't recognized it as OTTI. Have we tripped into any of the regulatory action levels or otherwise? So the markets definitely threw us a curveball, and I think what we want to think about here too is just the controls around how did management evaluate and document their judgments and conclusions around other than temporary impairments. So the other change that was thrown at us as well in the quarter, the CARES Act, which was enacted by Congress on signed into law on March 27th, was intended obviously to relieve some of the stress on the economy, and a lot of the provisions were designed to give available carrybacks and or changes in the tax code to, again, free up some additional liquidity in the market and or relief to the organizations and individuals. The enactment date is key here, March 27th being the date. That is under both statutory and GAAP accounting, the trigger for recognizing the impacts of those changes in laws into the accounting records. It doesn't give you a lot of time if you have to, see those law changes go into effect and then close your books by March 31st and file by May 1st. But some of the things to take into consider here in the control environment and just how this was impacting organizations, provisions allowed in the CARES Act to carry back losses or for net operating loss carrybacks was a favorable adjustment. And so thinking about some of the admissibility analysis that organizations may or may not have had available to them as they did the year-end 2019 reporting, that was another change that then allowed for some additional carrybacks if there were taxes paid in prior years. The modifications to the alternative minimum tax credit, the Tax Cares and Jobs Act had provided for refundable AMT if you had paid AMT in the past. There was a timeline under which those were being refundable credits to the organizations. The CARES Act enacted changes that allowed those to be immediately refundable. Modifications to the interest expense limitation generally is not going to impact the insurance entities too much, but I think the one that would take into account in your tax planning and thinking about things is the amendments on qualified improvement property, ability for bonus depreciation, and some changes to the overall depreciation life cycle to the extent you didn't take advantage of the bonus depreciation. So those are all items that come into play, thinking again about Q1 in the financial reporting and making sure the organization had thought through the impacts and considered those to the extent that they were material and making changes into those tax revision workbooks in order to account for that. I think the other thing to consider too, in just even 2019 annual reporting, as the audits were wrapping up, but also as you think about Q1, the deferred tax assets and the admissibility of those assets, to the extent that organizations were relying on unrealized gains on securities as being, available to them as part of a strategy for recognizing deferred tax assets, those unrealized gains drying up or going away and going negative as part of Q1. Also looking at forecasts of future taxable income and projecting the admissibility in the look forward period. A lot of uncertainty as we're dealing with the impacts to the overall economy, but also the impact in organizations and reliability around those tax income forecasts to allow for admissibility. So again, looking at the controls around those and the judgments being made, what data was being evaluated, who's reviewing it, documentation trail that management's leaving behind to support their conclusions and judgments and estimates, all being critical, I think, is a key component of what we saw going on in Q1 and the reporting thereafter. The other, I guess, curveball thrown at folks were the fact that June 1 commercial audit deadline was still ongoing. And so, as I said, Johnson Lambert, dealing with hundreds of insurance audits in process during the pandemic. Luckily for our organization, it was not an issue. We've been well positioned from an IT perspective to work remotely. And our clients actually, generally were very well positioned as well to be able to respond to go home and open up your computer tomorrow. You're not coming into the office, and we're going to finish this up remotely. So I think that was a stress on the organizations. But in most organizations that we deal with, we didn't see too much of a change as related to the audit, to the audit process. But the other area that I know that the finance teams and operational teams were dealing with was all of the potential data calls or analysis requests by regulators and/or AM Best, and then also policyholder relief initiatives where organizations were either mandated or voluntarily offering premium refunds and processing those, dealing with the premium moratorium as far as non-admissibility and not having to cancel policies potentially for non-payment, again, as a relief mechanism to the policyholders, and also looking at some of the other changes related to just accounting standards. Organizations carrying mortgage securities, direct loans that potentially were being modified under the stress that the economy was facing to the borrowers. Luckily, the NAIC and FASB and other regulators provided some relief to those entities that those modifications generally were not going to require trouble debt restructuring accounting, so long as there was not indication of default or credit risk before those modifications went into place. So a lot of those changes, obviously came at us fast and furious, thinking about how to get all of those changes enacted and then who's going to review and approve, I think are key areas for folks to think about as the dust is starting to settle. And, we're preparing for the next wave of financial reporting here in a couple of weeks for Q2, thinking about all of the changes and also looking back. Just want to spend some time, as Meg indicated, thinking about the risk environment and ERM in a changing world. Enterprise risk management, I think, has been a positive change throughout the industry, and that is becoming kind of the new normal, the expectation of that right-sized enterprise risk management. but also what's changing now when you don't have the team meetings potentially as effectively as they were, or everybody working under the same roof and having dialogues that pass along control information related to activities that are developing real time. And then, as Megan indicated, the fraud triangle, I think, is definitely an area of concern and will be for some time for organizations to continue to think about the risks that are being faced, either from a policyholder claimant perspective, or, as Megan indicated, thinking about the impact to individuals. Most of the organizations we're dealing with, we're not seeing the sting themselves, and effectively keeping the payroll intact and team and people working, but you don't know what's going on behind the scenes from a household perspective, and what their personal lives have turned into with the impact of the economy and the downturn in jobs. So we think about the incentive. Obviously, there is potential incentive and motivation for folks to take advantage of this scenario. Kim's going to talk a little bit about the incentive faced from outside, in the IT hacks and other phishing scams out there, but also thinking about just the motivation that folks are facing. Potentially we're not hitting earnings targets, we're not being able to sell the policies that we thought we were being able to because we're going door to door. Just other things going on that may be incentivizing folks, and the rationalization that comes along with that incentive of saying, I can. This is just going to be a temporary situation. I'll fix it later. Being able to cook the books, as Meg said, making some judgments to meet some specific metrics, or, thinking that there's going to be a way to fix it later on and rationalizing it. And that opportunity, change has definitely happened. Being able to have the same oversight, and authority and other opportunities that came along where, forcing organizations to close their doors and go remote, maybe forced quite a few changes in the IT environment where folks needed to have double duties in order to keep the process moving, either due to limitations on the IT bandwidth to allow a certain number of users to be working at a certain amount of time, having to work in different shifts, and or, as I said, everybody was facing personal situations at home, either caring for loved ones or children that are out of school, and the time of day as to which people were working, potentially providing opportunity for things that needed to get out the door to be pushed through in a way that wouldn't have followed the normal path, right? So I think what's important here is making sure we're considering fraud and the opportunities that are out there. The change was forced upon us. There's going to be a change, I think, too, in the way that we think about looking back and learning lessons from phase one of COVID-19. So thinking about the impact on internal controls, preventative versus detective controls, I think most folks are familiar with that, but just as a refresher, preventative controls are by design getting in front of a transaction before it actually takes place, and having a control step that requires authorization and or approval before a transaction moves forward to the next phase. Whereas detective controls are, by their design, looking backwards and looking for errors and or outliers in the process, and using hindsight to go back and investigate. And so with the shift in operations, thinking about some of those preventative controls that may have had to been relaxed or released, and now looking to replace those with some additional detective controls to go back and look back with hindsight to get in front of errors that may have occurred. And the frequency of controls changing too, thinking about some of the judgments and estimates we talked about with the OTTI and their tax changes. Most organizations have those as generally quarterly controls, but timing too, thinking about taking into account the subsequent event information up until the financial statements are released, having to monitor the markets and looking at changes daily. Is that a process that organizations had in place to take into consideration material swings? And as we talked about the rushed changes in order to keep things moving, I think that's an area, again, just looking back with hindsight now, thinking about what was relaxed and or removed in the process in order to keep the business operations moving, and how to right-size the control environment around the new norm, because we are looking at a remote environment, and oversight and management in a remote environment is critical in this process. So with that, we're to our next polling question.
Great. Well, thanks, Josh. So our next polling question is, what put the biggest strain on your financial reporting team during the March through May timeframe? premium billing, rebates processing, investment accounting and analysis, maybe includes impairment, tax law changes, internal, external audit, other, or non-applicable. So what put the biggest strain on your team? Again, don't forget to push the submit button, and I'll give you a couple of extra seconds here. And I'll be closing the poll. So it seems like premium billing and rebate processing was one of the most popular, with others coming a little bit, ahead. So Josh, I'll turn it back to you before we move to the last section.
Good. Yeah, so I want to just take a couple of minutes here just to refresh folks' memories and leave some action items for audit committees and or management teams to think about. So I think mentioned before, the risk assessment, looking backwards at what changed during this pandemic, but also looking into the future is important. The culture of controls, a tone at the top when everybody's under the same roof and the organization is hearing the same messaging at the same time. How does that look now in the remote environment and or the tone that's being set based on the overall economy. And so making sure that we've got thought process going into that. As I said, the internal control design changes and segregation of duties, if there were changes that were necessary in order to keep the business operation moving, making sure that those changes are still necessary or now able to go back and put controls in place to segregate what may have been incompatible duties in order just to keep the business moving. We talked about the control frequency and judgments and estimates, making sure, again, those don't fall by the wayside, and thinking about the data that's necessary in order to support the judgments and estimates and the frequency of that data. Vendor management is never going to go away. I think just the way organizations are now, so much more of what we do is being outsourced either to IT hosting platforms and or third-party administrators, and thinking about the impact, not only what's inside your four walls and what's now happening in the four walls of everybody in your organization's home, but thinking about what happened to the organizations that you rely on to continue to process some of your transactions, and that vendor management, and making sure you're holding inquiries with them and understanding the changes that they've gone through. As I mentioned, the disaster recovery and business continuity plans were forced upon us, and in order to be tested involuntarily this time, making sure you're thinking about the lessons learned and getting ready for the next time around, because unfortunately it sounds like this may be something that is not going away anytime soon. And I think the last one to remind everybody is just that fraud risk is not going away, and to make sure we're staying vigilant, looking internally at the motivations and or incentives and opportunities, but also looking externally as it relates to policyholders and or other service providers.
Okay, another polling question for you guys. Do you have well-documented internal control processes? Yes, but they are outdated. No. We would like help, or non-applicable. Okay, so a couple more seconds here, and I'll show the result and close the poll. And most of you said, yes, you have great internal control processes, which is good news. So let's move to our final part. So Kim, one of the most important topics in all of this has to be internal control over IT. Can you provide us with some thoughts on keeping the IT environment safe and secure with the move to the remote work? And can you also discuss processes and control that should be in place to prevent errors and fraud from an IT perspective?
Definitely, Mag. Thank you so much. I know we've gone through a lot of detailed information, and everyone, please hang in there. We're at the final section of the webcast. From an IT perspective, we want to understand system and control changes implemented to support the remote work environment. This is a very quick shift, unplanned test for the business continuity and disaster recovery plans. We also recognize that the impacts of the pandemic are evolving, and organizations are also considering plans to reopen offices. As our poll indicated, there were IT technical and logistical issues that had been encountered. And when we think about this, we see two themes. One is access and authentication, and two is data handling security. So from access and authentication, segregation of duties may have been relaxed to grant additional access if team members were out of the office or to support alternative control processes. Other network access or policy changes to accommodate the increase in remote work may have been implemented as well. VPN and remote desktops are a common remote work solution, and they may be susceptible to compromise if they were implemented quickly and not properly configured. Some VPN vulnerabilities were published and they are targeted by attackers. Microsoft recently issued warning that hackers have been targeting vulnerabilities with VPN servers from Pulse Secure, Palo Alto Networks, Fortinet, and Citrix. They've published steps to address those, and June's Patch Tuesday was the largest release in the company's history. So the key message here is to update your VPN and infrastructure devices with the latest software patches and security configurations. Remote desktop protocol is a Microsoft technology that enables virtual work on computers or servers, and those ports may also pose cybersecurity weakness if they were implemented quickly and improperly configured. There's been a significant increase in phishing and ransomware attacks with sophisticated research and reconnaissance. Some of those are including COVID lures like fake COVID-19 maps and World Health Organization lures. They're targeting your most valuable data and also your backup. So you need to make sure employees are alert, and also that you're using multi-factor authentication for remote access to keep those phishing attacks from being successful. Also related to authentication, you need to watch for predictable patterns and possible password compromise. For logical storage, users may be concerned with their internet speed, reliability, and they may be storing confidential data like PII locally on their work or personal devices just with the goal of being more productive. But there is a risk of data loss or integrity considerations. Users might also be printing documents at home, may not have appropriate security or shredding methods, and also file sharing tools need to make sure there are controls over access and use over cloud shared drives like Dropbox, Google Docs, etc. to protect security and privacy. One example is open links, making sure that users are not unknowingly granting access to others and that there's not a lack of an audit trail for who accessed that information. From an audit response, we just want to make sure we're covering the entire period and understanding those changes. For business process changes, this is the area where Josh had spoken a lot about is, if there was a move to a manual process or automated controls that were suspended or modified, we want to make sure that there are other controls that are being looked at. And for example, a process that was manual that's now using email authorization or phone authorization, there's a risk of business email compromise, or software might be used to take samples of someone's voice and impersonate them. So we want to make sure that there are multiple verification points or out-of-band verifications, like multiple phone calls to separate people. And we talked about some of the changes to support the legislative requirements that Josh mentioned, like premium deferrals, refunds, and credits. And we want to make sure those changes went through an approval process and that those are appropriately tested and approved before moving to production. When we consider the action items related to the IT considerations, we want to make sure malicious actors are going to take advantage of any opportunity, like a change in work routine, fear, rush to move to a distributed workforce. So make sure you're quickly identifying your vulnerabilities and prioritizing areas for improvement. So there's recognized frameworks and resources that are out there to support your function. One of them is Remote Work Security Considerations released by the DHS-CISA, or their Cybersecurity Infrastructure Security Agency. There's also multiple frameworks from NIST and Center for Internet Security, Top 20, that are great resources. Some of the top 3, and I won't drain the slide on this, is patching and security updates are critical. Make sure you've got an updated incident response plan. And again, like others mentioned, the third-party risk management. So I will go ahead and turn it back over to Mag. For our final polling question.
Great. So thank you, Kim. Have you updated your enterprise risk assessment in light of COVID-19 pandemic? Yes, no, non-applicable. I will leave you a couple of extra seconds. Again, have you updated your enterprise risk assessment in light of the COVID-19 pandemic? And I will close the poll. And it seems to be about exactly split right here. Okay, so if you have submitted some questions, because I know we have some question in the queue, since we're at the end of our time, we will respond to you in the next day. And if you do need some help, we have plenty of services to help you with your internal control. So just reach out to us, or you can submit a request on our website. I want also to remind you that if you'd like to subscribe to our email or webinar invite, you can also go on our website. And one of the important things is to download your certificate before you leave the platform. And you can contact us with any of your questions. Our information are right on the slide here. And really, I want to thank you for joining us today, and we hope that you, your loved one, your coworkers stay healthy and safe, and we also hope that your organization weathers the storm in this global pandemic as well as possible. So, and thank you again, and have a great summer.